What if our entire digital economy is on a collision course with physical reality? Well, today we're going to break down a really detailed forecast that predicts a major market shock in 2026, and it's driven by exactly that idea.
So to really get this forecast, you first have to understand the core conflict it's all built on. And it's this idea of the map versus the territory.
Okay, so think of it like this. The map, that's our whole world of informational assets. Stocks, algorithms, digital currencies. It's where value feels kind of abstract. But the territory, well, that's physical reality. The actual energy grids, the shipping lanes, the raw materials that let our world function. The entire argument here is that the gap between these two is getting dangerously wide.
Now, this isn't some brand new idea. History actually shows us a pretty clear pattern. You look back to 1971 when the US dollar was unpegged from gold, or think about the dot-com bubble bursting in 2000. In both of those cases, the abstract map of value drifted way too far from the physical territory, and it triggered a violent correction.
So the big question is, how is this same pressure building right now? The forecast actually pinpoints several specific things that are pushing our current system toward a very similar kind of breaking point.
First up, there's been a huge expansion of debt. We're talking trillions pouring into private credit and AI infrastructure. Then there's this really fascinating problem called model autophagia. It's almost like an echo chamber, where AIs are learning from other AI-generated data, and they start making these flawed, unreliable trading signals. And finally, you have institutional misalignment, where central banks are busy chasing digital targets while the real-world physical supply chains are literally fragmenting.
Put all those things together, and you get a situation that has pushed the global financial system into a state the model calls advanced pressure. The whole system is stretched thin, and that tension between the map and the territory, it's getting critical.
And to put a number on it, the forecast uses what it calls a structural pressure index. Look at this. The divergence between digital signals and physical reality scores a perfect 10. That's the maximum possible stress rating. Leverage stress is also incredibly high, at a 9. And you'll notice liquidity risk is at an 8, which points to things like quantitative tightening squeezing cash out of the system.
So when you add it all up, the total score is 34 out of a possible 40. Now, according to the model, that number is basically screaming that there's a high probability of a rupture. That's the point where abstract financial values have just stretched as far as they possibly can from real-world physical limits.
So what happens when all of this pressure finally gives way? The forecast predicts one single pretty dramatic event, something it calls the physicality snap.
This is the absolute heart of the prediction. It's talking about a sudden, forceful rotation of money. The idea is that capital is going to flee from speculative, abstract assets and rush into tangible physical ones, things you can actually touch.
And the trigger for this whole thing? It's called flash deleveraging. Basically, a super fast sell-off in tech and digital assets. And it's sparked by the moment everyone realizes that digital gains don't mean much when the real-world cost of energy, food, and materials is going through the roof.
But this forecast goes beyond just telling us what might happen. It also gives us a specific timeline and some key things to keep an eye on.
So the model identifies a 6-month window for this whole event, starting in August 2026. But it gets even more specific than that. It actually pinpoints a 1-week period of peak probability between October 29th and November 5th, 2026.
And these are the canaries in the coal mine, so to speak. The forecast says we should be watching for physical commodity prices spiking at the same time the tech stocks are falling. Also look out for sudden spikes in lending rates and unexpected shortages of really critical hardware or energy materials.
But look, with any forecast like this, you have to ask the big question: is it credible? A real strength of this model is that it's designed to be falsifiable. That means it gives us clear conditions where it can actually be proven wrong.
Yeah, so this isn't just some vague prediction. The model lays out very clear black and white conditions for failure, which is what makes it so compelling.
And here it is, the bottom line. If we get through January of 2027 and there hasn't been a major, obvious rotation of money from digital to physical assets, then the forecast is officially wrong. The model has failed its own test. Simple as that.
The forecast even tells us what could stop this from happening. And it would have to be something huge, like a global debt jubilee that just resets the entire system, or a genuine productivity miracle from AI that makes physical stuff radically cheaper by the summer of 2026. Short of something on that scale, the model says the trajectory holds. So in the end, this forecast isn't just about markets. It's really a test of our economy's connection to physical reality itself. And it leaves all of us with a really provocative question. How long can the map drift away from the territory before we're all completely lost?
This entire structured forecast was developed by the researcher and author Kevin L. Brown. It's actually an application of his bigger framework, which is called Triune Harmonic Dynamics, and it looks for these universal patterns in how complex systems evolve and change over time.